Well, crude oil prices are headed down again. And these days, nobody really knows what to expect crude oil prices to be. But oil prices have become quite a hot button this year. As you know, sanctions against Russia have affected oil prices. And prices spiked earlier in the year, prompting the United States to release oil from its strategic reserve. Higher oil prices led to higher gas prices at the pump. And that is something that the White House does not want to see. Especially in an election year. And, especially when the US economy is teetering on the brink of recession. As you already know if you follow this channel, OPEC+, the powerful oil cartel, an unexpected cut in production. Starting in November, the oil group plans to reduce its target production amount by 2 million barrels per day. This production cut comes as the energy dispute between Russia and the West continues to heat up. European countries are deeply concerned about what will happen to energy prices this winter. And the prospect of an economic recession and possibly even a winter gas shortage. President Biden publicly admonished OPEC+ and their de facto leader Mohammed bin Salman of Saudi Arabia. The move was seen by the White House as a snub to the United States and as Saudi Arabia siding with Russia. Russia is a member of OPEC+. But as you already know, Russia is under severe economic sanctions. And many countries, including the United States, have stopped importing Russian oil. And with the November elections coming up, President Biden wants lower gas prices at the pump. This video takes a closer look at recent movements in the price of oil. What are the factors at play and what to expect in the future? What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the US economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Crude oil prices continued their fall on Tuesday. The US benchmark grade of crude oil is called West Texas Intermediate, or WTI. The WTI crude oil price is now sinking to levels not seen since before the OPEC+ meeting. The November contract price for WTI crude declined to $83.22 per barrel. That is 2.64% lower than the day before. As you know, OPEC+ announced a production cut of 2 million barrels per day. That production cut takes effect starting in November. The decline in the oil price comes as the White House is talking about releasing more oil from its Strategic Petroleum Reserve or SPR. Specifically, the Biden administration might release another 10 million barrels. Or, even another 15 million barrels from the SPR. You might recall from earlier this year that the administration announced the release of 180 million barrels from the reserve. That release was to take place ratably over the course of 6 months. And November would be the last month of that release. So the newly discussed release might be part of the 180 million barrels. When that oil is finally sold, it would be the final portion of the 180 million barrels. But oil markets have a lot of other information to take into account as well. First, there is the prospect that the United States could release even more oil from the SPR. This would be seen as a move to bring down gasoline prices just before the November election. Also, the US Congress mandated the sale of another 26 million barrels of oil. This mandated release is for fiscal year 2023, which started on October 1st. But the release could come any time within the next 12 months. This prospect has oil traders worried that the US could release this oil quickly, as opposed to spreading out the release over 12 months. Currently, the US Strategic Petroleum Reserve has 405 million barrels in it. The Strategic Petroleum Reserve has a total capacity of about 750 million barrels. The US Strategic Petroleum Reserve is held in 4 huge salt caverns. 2 are in Texas and 2 are in Louisiana. But you might recall that some oil from the SPR was sold off during the Trump administration. In January of this year, there were 593 million barrels in the SPR inventory. And that is the lowest amount of oil to be in the SPR since 1984. But another release from the SPR is not the only factor affecting oil markets. Another crude oil storage build in private storage was reported last week. So there seems to be more oil in the system than was previously thought. And there is the persistent drumbeat of a worldwide economic recession. Practically everyone is expecting some kind of recession. But nobody really knows for sure. The Federal Reserve is aggressively raising interest rates in order to tame inflation. And that is slowing the economy for sure. But Federal Reserve Chairman Jerome Powell is expecting a soft landing for the economy. And China is continuing with COVID lockdowns. That is keeping gasoline consumption in China down. OPEC Plus is expecting slackening demand over the winter. So, the cartel has agreed to cut oil production by a whopping 2 million barrels per day. For those of you not familiar with OPEC Plus, it is a group of some of the world's largest and most powerful oil-producing countries. OPEC Plus includes Saudi Arabia, Russia, Iran, Iraq, Algeria, Nigeria, and other oil-producing nations. It does not include the United States or Canada, two of the world's largest oil-producing countries. Saudi Arabia is seen as the informal leader of OPEC Plus. This powerful oil cartel agreed to impose deep output cuts Wednesday. Oil prices have been falling for weeks now, and the group is trying to spur a recovery in crude oil prices. All of this is despite calls from U.S. President Joe Biden asking the cartel to increase oil production. Gasoline prices at the pump have spiked in the past week or so. And President Biden wants to help the global economy by keeping prices low. Crude oil prices peaked in June at more than $120 per barrel. But fears of the prospect of a global economic recession have put oil prices on a persistent downward trend since then. And high oil prices typically bring about demand destruction as people drive less when gasoline prices are higher. OPEC Plus is scheduled to meet again on December 4th in Vienna. Most of the production cuts are expected to come from Saudi Arabia, the United Arab Emirates, Iraq, and Kuwait. Energy analysts point out that it is difficult for anyone to predict oil prices 2 months in advance these days. The future of the economy and energy prices are highly uncertain as more European sanctions on Russia are added. Oil prices reached a 2-year high in March. But oil prices fell 25% between the middle of June and the end of August. The price decline has been driven by the expectation that interest rate hikes by the U.S. Federal Reserve would reduce demand for gasoline. And by concerns that COVID-19 restrictions in China would slow the Chinese economy and reduce oil demand. Although gasoline prices are generally high in the U.S., they never really got as high as many consumers feared. The average price of gasoline in the U.S. reached a peak of $5.02 per gallon on June 14. Since then, the average U.S. gasoline price has fallen to $3.79 per gallon. U.S. has become a major refiner and exporter of oil and petroleum products since 2016. The United States now exports 10 million barrels of oil and refined petroleum products every week. Geopolitics remains a key driver of oil prices worldwide. The price of West Texas Intermediate crude oil peaked at $130 per barrel in March. Multiple forces are acting on worldwide oil prices. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.